Hello, everyone. Welcome to our second Gabelli School Centennial Speaker Series webinar of this fall. Thank you for joining us for the Investment Stewardship Series, an ESG and value investing conversation featuring Diane McGeever and Gunjan Banati. My name is Donna Rapiccioli and have the honor of serving as the Dean of the Gabelli School of Business at Fordham University. The Gabelli School Centennial Virtual Speaker Series began in 2020, marking 100 years of purpose-driven business education at Fordham. In the last year, the Gabelli Center for Global Security Analysis and our wonderful partners at the Museum of American Finance and the CFA Society of New York have sponsored more than 30 events that drew nearly 5,000 attendees. We're tremendously proud of this dynamic partnership, and a full archive of our video content will be shared in the thank you email you'll receive after the event. At the Gabelli School, a network of industry partners and global thought leaders empowers our community with the vision and the values to use business as a catalyst for positive change. As guests, you're an important part of this work. So please help us share the word by inviting others to join our network. I'm really excited about today's session. We'll have a panel discussion between Gunjan Banati, Chief Risk Officer and Managing Director at Royce Investment Partners, and Diane McGeever, Chief Investment Officer and co-founder of IDES Capital Management, a firm that engages with management teams and corporate boards to implement practices that drive long-term value. Diane is hosting our series of investment stewardship talks with upcoming events that will be shared shortly. We're also super proud that Diane earned her JD from Fordham Law. Together, Gunjan and Diane will discuss investment stewardship and specifically the role of ESG and sustainability factors as material opportunities and risk factors for value investors. You know, we often think about ESG as still being in its earlier stages of corporate adoption. So it's really fascinating to look at ESG from a more long-term value-oriented perspective. Diane has a full range of questions for Gunjan to walk through, including a bit about her background and a little on Royce's policies related to risk management, as well as the role of ESG in those policies. Following the discussion, Diane and Gunjan will take questions from the audience, which we would ask that you type in the Q&A section near the bottom of your Zoom screen. Our speakers will answer as many of the questions as possible during the session, and Professor Jim Kelly will join me to facilitate this Q&A. Before we begin, I want to remind you that we do rely on donations to advance our mission. So I'll ask that you consider making a donation to the Gabelli School Centennial Fund. You can make a tax-exempt gift quickly and securely online at the link that we've provided in the chat. So now, without further ado, I want to turn it over to Diane and Gunjan.
Thank you, Dean Rapiccioli, and thank you also to Professor James Kelly, Professor Shrees Chatterjee, Annalise Morales, and Laura Rittenhouse, without whom this event would not be taking place. It is such a pleasure to be back at Fordham University, my alma mater where I studied law, and it is a true honor to receive such an incredible, warm, and rare welcome from the Dean of the Gabelli School of Business. Now, I say rare because Dean Rapiccioli, in addition to her countless academic achievements and her accounting, business, and financial expertise, is a female dean of a business school, which only adds to her status as a true standout. As I learned in preparing for today's event, Dean Rapiccioli has really broken the mold. She is part of a mere 17% of female deans at United States business schools. And that number, 17%, is a number that really hits home for both myself and I believe my co-panelist today, Gunjan Banati of the Royce Funds. Gunjan and I are not only female investment professionals, but we are also both small cap specialists. And 17% happens to be the exact same percentage of board director seats held by women at small cap public companies within the United States. So in many ways, our worlds intersect and collide. And while today, for me, being introduced by Dean Rapiccioli and being joined by my co-panelist Gunjan is a true first, I hope and expect and really believe that it is not the last. So with that, let's move on to the star of today's show, Gunjan Bonatti of the Royce Funds. Now, I could spend hours in conversation with Gunjan because she is a true expert and her role is far reaching and fascinating. But we also want to hear your questions, as the Dean mentioned. So over the course of our conversation, as ideas come to mind, please send them our way, and we look forward to hearing and answering them as we wrap up this event. And with that, let's start the deep dive. So Gunjan, I want to start with your background because I find that it is so helpful and incredibly interesting to start right at the beginning, the inception of your career, and to really understand the full path that led to your current role as Chief Risk Officer of the legendary Royce Funds. You studied management and finance as an undergraduate student. You spent a significant portion of your career in investment research, and then pursued a risk management degree and role within Royce. Can you please fill in all of the details and explain how your earlier experiences shaped the perspective that you bring to your role at Royce today?
Absolutely. Thank you so much, Diane. And thank you to Dean Rapiccioli and Fordham for giving me the opportunity to share my story with everybody. And I'm really looking forward to this conversation. I've had the pleasure of working on multiple sides of this business, and I'm really grateful for the perspective that it's given me. I started my career, very beginning of my career in fund accounting, and I learned structurally what a mutual fund is. I got some insight on the operational aspects of the mutual fund business, and it was a great way to get started. And then I spent the next 10 years at a financial planning firm. During the bulk of that time, I was doing investment research. I selected and conducted due diligence for a recommended list of over 100 different products across equity, fixed income. I covered hedge funds. It was a broad range and a great opportunity to understand all the different kinds of products, also the different kinds of investment styles, and meet several different investment firms. I would do a lot of on-site due diligence. And in many ways, due diligence is really investment and operational risk. You're trying to understand a strategy, the drivers of performance for that strategy. So you're basically conducting a risk assessment. And in the same way, you're also trying to understand operational risks when you do on-site due diligence. You want to understand, cybersecurity, key person succession risk, and things like that. So in many ways, investment due diligence is a form of risk management. At the time when I was in the financial planning firm that I was at, Allegheny Financial, I covered the Royce Funds. And through my due diligence efforts, I got to know Chuck and I got to know a couple of other members of the Royce team. And I have to say, I always admired the culture at the firm. So when I got an opportunity to work directly with Chuck, it was really hard to resist that opportunity. Royce as a firm it's a very entrepreneurial place. It's a place where you can really make a difference if you take the initiative. They give you a lot of latitude to shape your career and find the best way you can add value, which is one of the great benefits of working for a smaller company. So this firm, they've always had a culture of risk management, but when I got here, it was decentralized and it lacked some formal structure. So when I joined, I wanted to create a risk management program, something that would span the organization. But to be honest, I really didn't know how when I got here. I'd seen what good programs look like at other firms. I knew what it looked like when it was done well, but I didn't know how to get there myself. So I spoke to Chuck and our CEO, Chris Clark, and I asked him if I could go back to school and get a degree in risk management and try to figure that out. They were really supportive, and it was an incredible experience studying and applying what I was learning in real time. As the program has gained more acceptance across the firm and I expanded my remit, I covered operational risk, enterprise risk, and now ESG risk as well. And then I got to join the management committee as our chief risk officer. It's been a wonderful, wonderful experience here.
It's an incredible story, and learning the story through speaking with you in preparation for today's event, I was so impressed by so many aspects of it. Certainly, kind of the breadth of experience and knowledge that you bring to your role, but I'd say even maybe more especially the initiative to create a role, to identify an opportunity, and to create a role. And similarly impressed with Royce and the opportunity that existed there. For me as an investor, I would say that something that is pretty common in many of the very best companies that we've invested in is a strong central corporate culture that nevertheless empowers really, really smart professionals such as yourself to innovate. And so I'd love to kind of learn more about that because it is not that common, but it is really exciting to see.
Absolutely, this firm is that they actually do encourage an entrepreneurial mindset. They wish to give people the opportunity to expand their remit and add value. I mean, it's kind of a double-edged sword. When you look at a firm that actually, a small firm where it's very easy to make a difference and get noticed, it's also very easy to get noticed when you're not. So it does actually work both ways. But I have to say, it is being given the broader opportunity. I think it allows you to align your experience more directly with what it is you're doing, as opposed to being given a very prescribed job description. You actually get to select the items where you are most strong and then focus on those areas. And I think that's how you add the most value.
Certainly, and I couldn't help but notice that you included ESG, and that's something we're obviously going to get to and spend a lot of time on today. But before we go there, and before we kind of get to that deeper dive on ESG and sustainability and investment stewardship, I want to explore really the full scope of your work, because as Chief Risk Officer, you fill a broad-based and extraordinarily important role. I know that Chuck, in our conversations, in our weekly conversations, he regularly says that being an investment manager is really being a manager of risk. And I think that's absolutely true. And it really goes to how central and how critically important your role at a firm that is as big and with as many strategies as Royce has. So I'd love to know, more about your role, the overarching responsibilities, and really how you carry that role out.
Absolutely. Well, it's best to be the Chief Risk Officer in a firm that has a strong risk culture. So one of the things I feel most grateful for is this firm has an incredible culture of risk management. So it allows me to be able to do my job effectively. My primary responsibility at Royce is investment risk oversight for all of our strategies. Now that includes market risk, liquidity risk, and ESG risk. I chair our risk committee and I conduct regular risk reviews with each of our investment teams. These reviews, you can consider them as deep dives. They cover all aspects of the portfolio, and most of them we look at longitudinally. We're long-term investors, we're value-oriented for a number of our strategies, and really do take the long-term perspective. So it makes a lot of sense for us to look at these fundamental metrics and factor exposures over long periods of time. And the way I look at my job is it's to make sure that we're managing each strategy consistently. We're managing it in the way that we said we would, and I assess that through looking at these metrics and exposures. I also evaluate the effectiveness of portfolio construction. So that might be how we're weighting positions in the portfolio. Are we trading effectively? The timing on our buys and on our sells. So we do a number of deep dive assessments around construction. I think most important is that as active managers, we are in the business of taking risk, but we want to be taking prudent risk. So it's my job to make sure our portfolio managers are aware of the risks they're taking and that they're taking them intentionally. So that means looking at risk concentrations as they may happen across industries and sectors and across sectors. I would call our approach to risk management a collaborative one. We believe that at Royce, the responsibility of risk management doesn't just fall on me. This is truly a culture of risk. Everyone is a risk manager from their own perspective.
I really like that, and I definitely want to learn more about that. I really liked, not only the points around collaboration, but, again, the notion as investors, we do take risk, but it is prudent risk. We have to be properly rewarded for that risk. And I think kind of one of the overarching quotes, certainly for value investors, but really of investors of all types, really centers around the notion of, protect the downside, margin of safety, and really being able to sleep at night, and the notion that compound interest is the eighth wonder of the world. And, I know that you are absolutely responsible for, a very large portion of that, but to the point of collaboration, the portfolio managers take on that role as well. And so, I'd love to learn just a little bit more about how that process works. That's something at a firm as big as yours with so many strategies, I find that to be really interesting.
Risk management at the individual stock level is the point person for that is our portfolio managers. They're assessing risk and risk and return, risk reward for each of the positions that they're selecting to put in the portfolio. Now, what happens when you combine all those positions in a portfolio is that you end up with a portfolio level risk that's aggregated. And it's my role to understand what portfolio level risks we're taking. So when we combine those positions, where are our risks being concentrated in ways that we may not see those exposures. So one great example I could give you is, if you're looking at a particular theme that a portfolio manager might be following, he might be making investments across a number of different industries and a number of different sectors to propagate the same theme. And when you combine all of those together, you might have more risk than they thought they were taking when they took on the individual positions, because now you've compounded and aggregated those risks. And I find it very useful to have a, sort of that second line of defense, to have that portfolio level oversight that looks at that risk concentration. So we look at risk concentration from a number of different levels, and it really helps us have a different perspective of the portfolio than if you're just looking traditionally at sort of just sector level work or industry level work. We look at factor concentrations as well. And I think that can sometimes give you insights that you didn't expect to see.
I think that's absolutely true. I know, being myself a fundamental analyst in many respects, we're really focused on that kind of bottom up assessment of the risk factors, but that top down point of view that, you could have investments in many different industries, and nevertheless, there could be this underlying same fundamental bet. I think that is a perspective that, you can so uniquely bring, within funds and within the firm.
So I'm glad you mentioned that. We also then have to aggregate all that up at a firm level too. And I think that's really another important, thing to consider, because of course we're a small cap shop. We're completely focused on small caps. We're singular asset class. So for us, we're automatically taking a size bet, a big one, going small cap. So we also want to have great consideration about all the other risk concentrations that we're taking, given that we're already taking a very large bet as a firm.
Yeah, small caps certainly present unique opportunities and corresponding risks, and that's something we're going to get into, and we're certainly going to, most especially focus on, those risks and maybe corresponding opportunities that relate to ESG and sustainability. And so now I kind of want to make that jump to the more broad theme for today's discussion, which is really investment stewardship and ESG considerations. And I want to start off by sharing, there's so many things that are amazing to share about Chuck Royce and the Royce Funds, but one that I want to share that for me as a small cap activist who invests through a value lens is particularly meaningful, is that I've been following the Royce portfolios for years. In fact, my partner, Rob, and I, before we ever met Chuck, before we were honored to have him as an investor, have always said, Chuck is our investing oracle. Warren Buffett's talented. We always look out for, the namesake of Fordham, Mario Gabelli, jumping on earnings calls and asking the probing questions. But Chuck is it. He's our oracle. And so you can imagine how meaningful it was for me to, in addition to understanding, his incredible legacy as an investor and a value investor, to learn that when it comes to governance, Chuck and the Royce Funds have been thinking about these topics for a very long time, and it's really been a central part of the culture and the way that you at Royce invest. And that for me was just, incredibly meaningful. And so with that understanding, I think it would be helpful for the audience from a firm with the longstanding governance-focused practice to really hear your perspective on how ESG and sustainability fit into your investing philosophy at Royce.
Absolutely. I think, given, as you so well explained, Diane, at Royce, we have always had an exacting standard around principles of governance and sustainability in evaluating companies that we're investing in. We believe it has a material impact on business risk and corporate performance, and we've seen that over the years that we've done this work. We think governance has to be the starting point. It sets the framework for accountability and decision making, as well as setting the tone for corporate culture. We don't think you can have, a lot of the E and S if you don't have the foundations of governance. And so that's always been something that we've looked for. And in small caps, especially, good governance structures are extremely important. These are the most fragile of businesses. So having a strong governance framework is extremely important. So when you go onwards from there, the application of ESG integration and then engagement strategies, those are then going to vary on top. How you apply them is going to then vary on top of the type of strategy, just as the application of fundamental analysis would. So when we look at the range of different types of strategies we have at the firm, we're using different fundamental metrics to come up with those strategies, to understand those strategies and measure them. In the same way, we think that there's sort of different approaches to ESG integration and engagement that make sense for each of the strategies. We don't really follow a one size fits all approach, but we certainly do have a baseline around governance that all of our strategies look at. But when it comes to applying ESG, we're considering things like the domicile, the time horizon, the investment objectives, the concentration of the portfolio. They're all going to some degree, influence which and to what extent you're able to integrate ESG factors.
I think,
sorry.
You continue. Please continue.
For example, if we were to look at a long-term, high-quality, concentrated strategy, it would be a great candidate for binding ESG integration, because the foundations are already built on governance and the concentrated portfolio makes engagement very actionable. Alternatively, if you're looking at a deep value strategy that's buying turnarounds and distressed stocks, it needs to be very diversified to mitigate risk. Now, they aren't going to have the same standards that they're going to apply for quality, maybe for governance. They aren't going to be looking for best in class, but they are going to be very cognizant of ESG risks to avoid blowups in a portfolio like that. It's downside ESG risk mitigation that you would be employing in that strategy, and engagement over 300 stocks is not really as impactful. So we really do think about what our strategy is trying to accomplish and what's the best way to integrate ESG into that strategy.
Yeah, I think that is so fascinating that, ESG, the existence of strong factors and especially governance versus the lack of them, that it really can drive, portfolio construction and kind of the level of diversification that's requisite within a particular portfolio. And I also think that the point that you made, that governance is at the center of everything, it's an often overlooked point. I mean, we hear today, it's all over the news, ESG, as if they're kind of verticals in and of themselves. But without the governance, without kind of that buck stops here mentality that exists at the boardroom, there is no E, there is no S, and there's also not generally, operational success in business execution and strategic execution, especially over the long term. And so I really think that kind of grounding focus on G, enabling, the execution across these other themes, not only on the business execution side, but also across sustainability themes, is such a really important, and I would expect very, constructive way to think about it and to assess and analyze prospective investments as well as current portfolio investments.
Absolutely.
I think with that, and I think there's some interesting points you raised there that we're going to get into that actually highlight maybe some of the differences between, we've got a lot of similarities. We're both small cap focused. You have many strategies, but certainly value like IDES is a big part of it. But then there's some differentiating points. I think we're going to touch on some of that. But I want to turn back to your specific role again. And for me as an activist, why it was so striking. So when Chuck first shared with me, a bit about your work, Gunjan, and he speaks so incredibly highly of you and has so much respect for really your very holistically informed perspective, I was intrigued to learn within the Royce funds, ESG and investment stewardship oversight is incorporated and really led by you, the chief manager of risk at Royce funds. And this fascinated me, because as an activist investor who implements broad-based changes at the companies we invest in, I often find that the ESG message that most quickly and most meaningfully resonates with our portfolio company boards and management teams is not the upside proposition, but it's rather pointing out the extreme downside risks and potential for risk and faced by companies if they ignore ESG, if they're not implementing best policies and practices. And so we often say to companies, if you're not thinking about these topics, you're exposing yourself, your stakeholders, which include your shareholders, to tremendous downside. And, in the activist world, we tend to call this, carrots and sticks, the proverbial carrots and sticks. The carrots are the upside, the sticks are the downside. And so I want to start our conversation there. Let's talk about ESG. Let's talk about sustainability through the prism of your role, risk and risk management. Why are ESG shortcomings risk factors, especially for small cap investors? And how do you assess these risks? Tell me more about that analysis. Tell me how it works. Tell me your role, the PM's role. I'm really excited to learn more.
Absolutely. We really began our journey into ESG from the risk perspective. It started out through our risk, through our risk reviews, which is our risk management committee does these deep dives on our portfolios, as I mentioned, and we added an ESG component to it. And what we hoped to achieve was to highlight to our PMs at that time what ESG risk exposures they had in their portfolios, and help possibly identify some engagement candidates for them. And that's really where it all began. And that was early on, and it was very well received. Our PMs wanted to understand how to incorporate this data better, what insights they could get from it, and then how to customize it to their individual strategies. Because you can't just, there's a lot of ESG data out there, and really it's the application of it as it makes sense to the strategies that makes it really value add. So we started off with just sort of introducing the data sets, introducing the exposures to our portfolio managers, and then from then on, we went on to customizing them. And when it comes to identifying which ESG factors are meaningful for each investment strategy, that's done at the strategy level. My role is the oversight at the portfolio level of what the risk exposures are, and the PMs are looking at those individual factors when they're buying stocks and when they're selling stocks. And maybe it would be easier if I walked through sort of an example of how a portfolio manager thinks about integrating ESG in one of our strategies.
Yeah, so I think that would be super helpful.
Yeah, I think that would help. So the strategy that I'd focus on would be one of our quality strategies, because I think those are the ones that probably lend themselves best to how they look at ESG characteristics. So
That's great.
So, in our minds, these ESG issues should all be viewed as factors. You're going to look at them alongside your traditional financial factors and your operational risk factors. And we consider a company's ESG characteristics to be a vital component of the overall quality of the company. And ESG and management quality, they're systematically, explicitly evaluated as one of sort of 5 pillars in a quality scoring methodology to be added into a portfolio. So they're looking at prospective and current holdings, scoring all of them based on 5 pillars, including ESG and management quality. So the ESG integration in the traditional sense begins with an internal checklist. They have a scorecard of a company's management quality, and they're going through, first of all, key corporate governance attributes, because those are the foundations: board composition, management incentives, shareholder rights, audit characteristics, things like that. Then they've also customized an ESG survey that then seeks out direct input from company management on policies, disclosures, and they're determining which of these to request. They're deeming which ones are most material for that particular business model, and they're requesting those. Okay, so to define that materiality, our portfolio managers are using, in part, their own judgment, understanding the companies and how they want to construct their portfolio. They're also being informed by SASB's materiality framework. So for those who are less familiar with SASB, SASB is the Sustainability Accounting Standards Board. They're one of the well-recognized providers of accounting standards in sustainability. And what they're trying to do is they're identifying financially material issues, which those are issues that are going to be likely to impact the financial condition or operating performance of a company. And therefore, they'd be interested, investors like us in the industry would be interested in those. And then they break those issues down into general themes. Then they customize each of those themes to individual industries. So you look at the stock that you're focused on, the industry that it's in, and it helps you determine, using SASB's framework, it's a guide that helps inform your, in this case, it informs our checklist, it informs our engagement efforts, it informs our survey, and that's how we gather information from our companies. Then this internal analysis that we do is then enhanced by looking at external ESG ratings from the the regular ratings providers out there. We use that sort of like we do sell-side research. It's to inform, try to bridge those gaps. We do some reconciliation with that data, and we're trying to make sure everything is aligned. So it's this combination of an internal checklist, an ESG survey, and these external ratings. We bring it all together, we come up with a final ESG score, and that directly contributes to a quality score that determines what makes it in the portfolio and what makes it out of the portfolio. So it's sort of a binding ESG integration process. Now, we wouldn't expect there, to be a huge volatility in the scores, but as more disclosure becomes available, you might see some changes, as it might end up changing some of the scores as more disclosure becomes available.
Yeah, and we're going to go through an example of a company that maybe didn't get such a great rating on the ESG front, on a no-name basis, of course. But, one thing that you said that I thought was really, really interesting, and I kind of want to rewind back to, and it actually ties into where you kind of ended up. I'm wondering, across the different strategies, the many strategies you run at Royce, do you see different themes emerge? Do you see different ESG and sustainability risk factors be more present within one portfolio versus another? Or is it really just a function of, what might be in that particular portfolio at that point of time? Do you see anything like that emerge?
Our portfolios in the small cap space, we do definitely see some trends, specifically around governance that we commonly note. And some of those might include, long tenured board members, lack of diversity on the board. We have a number of consistent themes that we do see in particular areas, but otherwise I would say it's relatively diverse, and it's certainly more diverse on the ESG opportunity side. But I would say our key focus, on ESG integration is definitely initially around getting those governance standards up. And then the next piece, as boring as it sounds, it's disclosure. That's the other key theme. We're just trying to get the disclosures out there so we actually can, actually go back over time, and we would hope to then identify, more thematic ESG factors in our strategies. But right now it's really, the disclosure just isn't there for us to be making sort of higher order, prognostications about what might be happening.
Yes, and we are definitely going to do a deep dive on disclosure because, as you mentioned, especially within small caps, it is a challenging aspect of being an investor. It's maybe where an investor can have an edge, but it's certainly something that small cap companies need to work on. So I want to go into that example that you and I chatted a little bit about. And I think it's interesting because it's also going to maybe clarify ways in which the Royce strategy differentiates from the IDES strategy, why something that maybe doesn't make the cut for Royce could exactly be the type of opportunity we're looking for at IDES. So I think it was a distributor company. Is that correct?
Yes. Well, this is the kind of really exciting and sort of sexy investments that we do here at Royce. They're a distributor of what are known as C parts, which are these little screws and fasteners. They sell over 1 million different parts. This company's been around for about 190 years. And because of this very long-term record, they've built a lot of experience, not only in selling these parts to their customers, but they also advise them on how to be more efficient and save costs. And so they kind of offer some consulting service alongside with selling these little screws and fasteners. This is a company that we knew a lot about. It's been in our space for a long time. And through our ESG survey, we then became aware of some red flags around governance. Those were, and as I mentioned before, ones we often see in our space, which is poor board dynamics, low board diversity. The CEO and the chairman were both family members, and the chairman had been on the board for just about 20 years. We saw issues around management incentives, a poor compensation structure. Majority of the compensation was fixed, and they had minimal long-term incentives or performance-based compensation. And in terms of shareholder rights, we saw multiple share classes, and they'd had a long-term auditor that went back to 1986. So as I said, these issues are exemplary of what we often see in our space, and these type of issues are not uncommon, but they are red flags for us. And in some instances, we would choose to engage with management on these particular issues, and we have in the past. But in this particular case, it was a confluence of one too many governance issues, and it really impacted the overall score for this stock. And so it fell below the threshold, and we had to divest the position. But that would be a fairly common example of what we walk through.
Yeah, and I imagine, probably not dissimilar to our approach at IDES, these are risk factors, these shortcomings that are, many are governance related, but they could also be environmental or social related risk factors. If the value is right, maybe it's okay to take some of those risks. But when you see so many red flags, there may not even be any upside valuation that is compelling enough that could overcome that list of problematic practices. I'd love to know more about that.
Yes, exactly. So that would exactly have been the consideration. We'd also, understand the dynamics of the company and the dynamics of the management team. We also, we meet with thousands of companies. We meet with them many, many times. And as we go through that process and we get to know management, we get to understand the dynamics of their board, we can also tell where and when we think engagement will be effective. And there was also sort of a judgment call made in this case that engagement would probably not result in the outcomes that we wanted. And so we chose to divest. And this is also aligned with other things that are happening with the company, with the industry, with the market. So of course, valuation is a consideration. And when we don't see an alignment, we see this additional risk and we're just not getting the value for it, we aren't going to take on that extra risk if we don't feel we can turn things around. And that was the case with this particular stock.
And I think it's a really interesting point, especially between the two of us, again, where our firms, there's so many points of intersection, but, from a differentiation standpoint, and I think this is true of many, if not the vast majority of investors, those types of risks, you as an investor, you are just going to move on. You're either not going to buy the stock, or if something changes, you're going to move on. Conversely, for us at IDES, those types of practices, which I think we very much agree, hold back the operational execution, the strategic vision, the long-term ability for a company to protect and grow capital. That could be something for us that's quite compelling. But again, we have to sit there and you brought up the word materiality. I think it's so important to highlight in this conversation, because I think often when people hear ESG, they wonder, is this, just an opportunity to do something good for the world? But we are investment professionals. It's our business to protect and to grow our investors' capital. And so, doing something nice would be really putting the cart before the horse. It's our job to make money for our investors and to protect their capital and grow it over the long term. And so I think in that way, we see things very, very similarly. And the decisions always come back to the value proposition, the capital that's at risk, and the potential to grow that capital over time.
Absolutely. And these are material governance risks.
Absolutely. So on that point, on the point of growing capital, let's move to what I kind of referred to as the carrots, which is, the undeniable fact that, a world that is focused on sustainability, that is focused on positive ESG practices, there's a very compelling upside case inherent in many of those policies and practices. And I know that you've had some great examples that we walked through. I wondered if you could share a little bit more about how Royce thinks about the upside opportunity inherent within ESG and sustainability, and then share those practices with our audience.
Absolutely. I think I have a great example to walk through, which really describes, what we do when it works and how it works well. And I think this would be quite instructive to share also how things work in small caps, and where really sometimes it is, it's really the small things that make a difference. And here I can share an example of that. So this is a leading intellectual property professional services group company. And during our analysis, we do our baseline analysis, as I said before, key pillars of corporate governance that we're going to cover, and it checked all of those boxes. And then to better understand some ESG specific risks, we send the company our proprietary survey. We're trying to understand risks, opportunities in ESG as covered by the survey. And when we received these responses back, we learned that there were metrics that were related to employee engagement, diversity, and inclusion that were material for this company, that they had indicated that they were currently tracking internally, but they were not agreeing to publicly disclose this information. So in a case like this, we choose to engage with the company on this. We emailed company management and we encouraged them to enhance their public disclosure. This was around employee turnover and employee engagement. We were then able to cite the importance of this issue by tying it back to that SASB materiality framework. We're saying SASB says that this is material for you guys. Investors are interested in it. We strongly encourage you to please publicly disclose this information. And then we learned that the company, they got back to us and they said they're making investments in HR-related software that's going to make it easier for them to disclose not just this, but other employee-related metrics, and they're going to put that out there. So that was, for us, a really positive outcome. And the story doesn't quite end there. That was one piece of the analysis we did. For the same company, we then also looked at ISS's assessment. They do a corporate governance assessment, which is called a quality score. For people who are familiar with it, they put out a report with a quality score. We noticed that ISS had deemed this particular company to fall into the medium risk category. And that was based on a poor score on shareholder rights. So specifically in this case, ISS was concerned that the company had at their last annual general meeting, they had employed a show of hands approach as opposed to one vote, one share. And so they rated them as being of medium risk. But based on our research and the information we had gotten back from the company, we knew that they had changed their voting method to a poll at their last general meeting. And so again, we engaged with management. We requested written confirmation, supporting documentation that the company's last annual general meeting did indeed conduct a poll. And then we sort of matched those two pieces of information together. We received that, we share it with ISS, and then this resulted in ISS amending their assessment from medium risk to low risk. So, give a little, take a little, and it works out. And I think it's beneficial for everybody. Not only was it beneficial for the company in that it raised their score, we learned more about the company culture, how they're operating, but we were also able to make the data in the public domain for all investors more accurate. And that's, and I think that's meaningful.
Okay, so this example touches upon so many important themes. And the first one that I kind of want to center on and do a little more digging on is the overarching theme of investment stewardship. We talk about ESG, sustainability, and investment stewardship, but investment stewardship is really kind of its own area of focus. And for everyone in the audience, there's many aspects of investment stewardship, but when we as investment professionals are dealing with investment stewardship, we're largely dealing with two broad areas. And we would characterize that, and Gunjan, I want you to fill in here, but engagement, and investors have many different ways of engaging. There's certainly some pretty similar types of engagements that Royce does and that IDES does, and then there are some very different types of engagements that we each do. And then on the other side of the spectrum, proxy voting. So as an owner in a company, every year there's an annual meeting. Every year directors come up for a vote. Other topics such as auditor, compensation policies and practices, and lots of other types of items come up to vote. And that's the other kind of broad area for investment stewardship. So I know you've touched a lot upon it there, but engagement for Royce is really, really important. And I'd love to know anything else you'd like to share with us about the engagement process at Royce.
Sure, absolutely. So at Royce, we really when our deep dive into ESG issues identifies things that we think need to be communicated to company management. We don't hesitate them. We don't hesitate. We raise it just as we would operational or financial issues. It's a big part of, it's not an afterthought in our engagement. It's a big part of our interaction with company management. And in terms of sort of stats around engagement, we engage over 1,000 companies. A third of them we're going to meet 2 or 3 times to really make our case of what we want. And some of them, about 10% of our companies, we'd meet 3+ times in a year. So we're coming back to the table when we're not seeing the results that we want to see. And we're sharing with them, say, for example, if we vote against management, we often go back and we share with them why. If we see things, we are actually interacting with them. It's a positive interaction. We call it positive engagement because we believe it's beneficial to company management as well. And one of the other great value adds we've been able to do for companies is we also, just based on our long-term experience of having met with so many companies, we've been in business for 45 years, and we've met with many, many small cap companies. We have over time amassed knowledge base and almost a library of policies and procedures that we can share. So in terms of the knowledge base, we have experts. Our portfolio managers are experts in things like designing compensation plans and in designing different kinds of compensation strategies. They share this with company management. Company management approach us for those expertise. We have experts in accounting that share, that will share with company management better methodologies. And then we also, in the same light, we have been amassing this, this library of ESG related policies that we then can share, redacted policies we can share with company management, because small cap companies don't have the resources. They don't know where to go. They don't know what to report. So it's almost beneficial to them when we approach them with this information and help them do better. They want to do it too. And to be honest with you, it's very positively received.
Yeah, I would hope and expect that. To your point, Royce has been around for, as you said, decades, has this phenomenally successful track record across so many strategies. And, I guess as an activist, we sometimes get a little bit of a different welcome. I would hope and assume that you guys are largely welcomed through the front door. We by and large are, but every once in a while we might be kind of shouting through the window at the management team. But is that largely your experience? And if a company is resistant to, you know, items that, you know, in your incredibly well-informed experience, again, are material risk factors or opportunities, is that a red flag for you?
Absolutely. You know, we approach each company, our ESG, you know, we do this process of ESG decision making, and then we approach our engagement through a sort of an ESG playbook, and it has three main components. First, we're going to ensure that our portfolio companies are publicly disclosing those material ESG metrics or policies that we know that they're actually already monitoring internally. So we know through our research and analysis that they actually already have this information. And then we tell them, please put this out there in the public domain. So that's sort of easy step one. And we see how that's received by company management. Then, you know, we want to seek to improve their ratings. So then we're going to identify disclosures where they could rectify something, they could improve the certain aspects of their disclosure. And then we're also going to go back to those ESG research providers and that are not giving them adequate credit for the work they are doing. And then we try to bridge that gap, you know, improve a little here and give them credit there, and match those two up so everybody's seeing what we're seeing. And then lastly is where we do make a push around ESG policies that they don't already have in place. And probably it's the third one that is the heaviest lift. But you know, if you've built credibility, if you built a relationship over steps 1 and steps 2, you do have more success in step 3 when you're working with those companies.
Agree with that. And I think also that focus on ESG, those themes in many ways are so positive that the dialogue is really elevated with the management teams because of the topics that are being focused on. Just touching really quickly on proxy voting, which is something that, you know, we tend to all kind of have a very I guess, protected point of view on, or, you know, quiet point of view on. But, you know, it's something I know you certainly take very, very seriously. You are, you know, very large investment firm, very big shareholders. And I know it's a very thorough process that, you know, not only has information from outside expert firms, but is also largely very much decided within Royce. Anything else that you would share about proxy voting at Royce?
We vote 100% of our proxies. And, you know, we vote them, the way our proxy voting practices are designed, it's to vote in a way that's consistent with maximizing the ESG score of our holdings. So we have very specific policies around how E and S are voted. And for G, we have, you know, there's many more nuances that would go into that, that our PMs add those additional, additional, you know, understanding and knowledge around that. You know, around board members, their relationship with the company. So there's many more nuances around that they have very specific views, certainly around it. And E&S, I would say we're consistently voting in line to improve those scores. You know, we of course take our fiduciary duty of proxy voting and the effort that goes into those decisions. You know, it's very important to us, and we do review every proxy diligently before we submit our votes.
Yeah, well, I have one more question for you, Gunjan, that I'm going to get to. Of course, I could ask you questions for hours, but I know that we have some questions that have come in from the audience. So I know something that you touched upon, and we at IDES could not more wholeheartedly agree, is the importance and really even, I'd say, the lack of disclosure, of robust disclosure within the small cap space. It's a huge risk factor, which means that it's also in many ways a huge opportunity. And with respect to not only kind of operational and financial metrics and data around ESG policies and practices, you know, is something that we're squarely focused on, because we are of the belief that what gets managed, what gets measured gets managed, and putting that information out there really can hold a management that can hold their feet to the fire. So I'd love to kind of learn more about your take on that and how you, you know, engage with your companies around the importance of disclosure.
Small and mid-sized companies definitely have less public information that's out there, and given that lack of disclosure versus large cap companies, it makes sort of relying on ESG data from third-party providers, it's going to give you an incomplete picture. So it's really very hard to just plug in and think you're seeing everything. It just doesn't work that way. And as I've shown through multiple of our engagement examples, you know, this is, we heavily engage around disclosure. And what's become apparent to us, the more work we've done in ESG and integrating ESG, is that we just have to do more work ourselves. And at Royce, we're active managers. We believe that this kind of market inefficiency where we need to do the work ourselves is really an opportunity. It is an opportunity for us. It's a value add. It's an area we have expertise in. And so we're willing to invest our time and effort into this, into improving these disclosures, helping companies know which disclosures to put out there. And then we hope as the information becomes more readily available, as the information becomes better, the quality of the information becomes better, we're all going to gain better insights. And it's better for us, it's better for company management.
I think the thing that is so impressive, I think as I highlighted at the outset, the incredible streak of empowerment for entrepreneurship within Royce. Something else that strikes me on this conversation around disclosure is that, Royce, you practice what you preach. Royce, for everyone listening in, has, I wouldn't call it an encyclopedia or even just a library. It's like a presidential library on investing expertise and wisdom, and ESG and sustainability, and investment stewardship wisdom. And so I would, obviously commend you on that. There are great videos up of you, Gunjan, and your colleagues, and point everyone here to that as a resource. With that, I really am excited to hear what is on the audience's mind. So I'm going to let the questions come in.
Excellent. Thank you so much. This is really amazing. I'll jump in with the first question. It's from someone I know really well, Jamie Vizicante, and he's asking, what benchmark indices are you using to measure your active performance versus the market? Do you use both ESG and non-ESG benchmark indices? How are you comparing your performance?
Sure. I'm assuming that question is for me. Diane, I don't know if you have a comment you want to make on indices, but I'm happy to talk about it. Yeah, so I mean, we benchmark against the Russell 2000. We do not use an ESG benchmark at this point to benchmark any of our strategies. I would say that, understanding that there's very low coverage, especially in the microcap space, which is the bottom half of that benchmark. We find when we look at ESG ratings providers, we have less than, well less than 50% coverage for any of our microcap strategies. So we don't feel that the data is there sufficiently to be using an ESG benchmark, but we would hope to one day be able to do that. I'd also add that, all our strategies follow ESG integration. We at this time are not actually running an ESG mandated strategy, so we don't run ESG product. And that's just because we don't feel that the disclosures are there yet where we could do that with confidence. And we hope to eventually. We have some products that could be well aligned in the future, but we really feel like we need to get disclosures up to that point before we'd be comfortable.
Thank you. It's a wonderful discussion. Both of you, thank you so much. You focused properly, I think, on the importance of the G, the governance and disclosure. What about, where does E and S fit into the equation?
Yeah, absolutely. That's a great question, and I'm glad somebody asked it, because it is, as we mentioned, when you start, you have to start with the G, and then you can move forward with the E and the S. So we see definitely more, we have E and S investment opportunities, so sort of positive investment opportunities on the ESG side. But when it comes to engaging around E and S, what we found is it's just disclosure. We just don't have sufficient disclosure. So that's the main engagement focus for environment and social. But we do certainly have themes where we're taking advantage of ESG trends that we see, and those tend to revolve a lot around E. So I have numerous examples of companies that we were able to invest in where we were, taking advantage of an environmental trend that we saw, and those would be slightly different. One of the examples I could give you is a shipping company that we're invested in right now. It operates these new build vessels with an eco design feature. So this is to increase fuel efficiency, and those sorts of investment opportunities often cross our path, and we will take advantage of them. But they're sort of definitely more on the opportunity ESG trend side rather than the engagement side.
Here's another one, relating to the SASB, which is a partner of the Gabelli School, which we're super proud of. So our students learn about sustainable accounting standards in their coursework. But the question says, how dependent are you on the SASB materiality score? There's been some confusion about a coherent standard in ESG investment. And some complain that it doesn't account for bringing positive change in traditionally un-ESG sectors like gaming and lodging. Is there anything to be done about it? It's kind of a mouthful of a question, but if either of you want to comment.
I'll
Diane,
jump
you
in
wanna
on this a little bit, you know, because I think from the perspective of an activist investor, we are very different than the vast, I'd call it 99% of the ESG impact focused universe. And that's because we can own anything. So the vast majority of ESG products that are out there today are largely composed by either positive or negative screening. Inclusionary screening, meaning they're going to invest in companies that already have boardrooms that are diverse, or exclusionary screening, meaning that they're not going to invest in fossil fuels. Now, you're not likely to see us show up in a fossil fuel, but that's because, again, it comes back to the value. We don't think that's a good place to put money. But in terms of policies and practices across ESG that are retrograde, that's our sweet spot, engaging with companies, engaging with stakeholders to improve those policies and practices, and then to, through an improved valuation, reap the rewards as a shareholder from those improved policies and practices. That's exactly what we do. Now, SASB was brought up. I know, Gunjan, you guys looked to SASB. We look to SASB as well. We are members of the SASB Alliance. We think that they have done incredible work and really industry-specific work that is a starting point for how we think about risks that may be specific to a company and an industry that we are considering. But I think probably, and I'm interested to hear your point of view, Gunjan, that's just a starting point. It's a jumping off point for us. It's a base framework, and then we do a much deeper dive to understand the particulars that a company may be facing, you know, from a risk factor perspective.
Absolutely, I would definitely echo Diane's points there. So I mean, we think SASB's framework, we're also SASB Alliance members, and I think the framework is hugely instructive. It really does help. And we use it as a starting point for our ESG survey, you know, understanding what questions to ask which companies. We use it as, you know, a framework for engagement. We definitely are relying on it, but you can't, you know, we don't find that we can just solely rely on that. We're also informed by many other elements, including, you know, ESG data providers and you know, our own engagement efforts and what we learn directly from the company. So it is a piece of the puzzle, but we certainly haven't found it to be, you know, the whole piece, you know, the whole thing. We actually need to supplement.
Okay. Here's a question for both Diane and Gunjan. Is there a minimum shareholding ownership percentage that you'd need to get the attention of management?
Diane, you want to go first?
We've been very loud with small investments. So we have engaged in proxy fights and prevailed when we were sub 1% holders. And I think that the takeaway there is, you know, it's really at the end of the day for shareholders about the quality of the ideas and the depth of the diligence. And, you know, as an activist, the compelling value add that I can present to help a company to a much more prosperous and risk-averse future. And I think that, you know, maybe historically there were notions around scale requisite to be impactful, but I think we've proven it, and I think there are other firms out there that have proven that that's not necessarily the case.
Yeah, I would also add to that, you know, from our perspective, when I look at ESG risk at the portfolio level, I'm looking at our largest positions, and if I'm seeing any of our larger positions having material ESG risk issues, I'm asking portfolio managers to engage in those cases. So we would expect all of those significant holdings certainly to be ones that we've engaged with on these material issues. But in terms of a minimum size, you know, for us, it really is dependent on so many factors. We also sometimes have prospective companies approach us and ask us which sort of ESG disclosures do we think they should be putting out there so that we'll invest. You know, it does run the range.
Very good.
We still have a few questions. I'm wondering if you can just stay a couple of minutes over to try and answer them. We'll try and do them in a lightning round.
Okay.
So we have a question about greenwashing. Do you encounter it in the small cap space? do you believe ESG ratings are doing a good enough job differentiating PR efforts from concrete action? You did talk a little, maybe a comment on that.
Absolutely. I think greenwashing is a huge risk in the industry. I think everybody has to be, mindful and transparent about what they're doing, and really, walk the talk in this particular space. So yeah, I mean, I think if you're purely reliant on ESG data providers in the small cap space, that's a difficult place to be. Because I just don't think that the data is really there to the level. I think we've been very cautious. So, we have an ESG integration program. We are designing and customizing it by strategy, but we're not putting out product. And there's real reasons for that. We want to really be able to stand by everything we put out there, and we need the information to be up there where we need it to be. And so I think it's, when you get to the point where you can customize your approach by your strategy and actually have sufficient data to back up what you're doing, then I think it's the time to be putting out product. Until then, I think we will probably wait. But yeah, I do think it's a risk. I certainly think it's a risk.
For Diane, when you approach a company, do you approach them as a friendly advisor initially, or something else?
Yeah, so, I think what's interesting is at our, root, at our core, we are value investors. Now, we are empowered with a toolkit of engagement that we are, very effective in running, that helps us help companies overcome problems that they may be facing. But most of our very first interactions, the wide majority, are probably no different than many Royce analysts or other kind of fundamental investors that are calling up a CFO or a controller to say, what is this balance sheet item? Walk me through this. Explain the cash flow statement. I want to understand how this is actually working. And so that is generally our first engagement. But then, as we move on and we, decide to make an investment, and we always engage. There's nothing that is in our portfolio where we're sitting on the sidelines. Now, there are varying degrees of engagement. It's always our hope to have a very constructive engagement. We are never out there being egregious for the sake of being egregious. And really, it is a waste of everyone's time to get to something that looks like a proxy fight, to even begin walking that path. So, it is always our hope, and it's been, with eyes, I can say, and very happy to share that it is the vast, vast, vast majority of our engagements with management teams and boards that they are truly positive and really wonderful experiences. And as I mentioned earlier, I think that, our founding focus at IDES to not only focus on traditional activist points of operational or strategic execution, but to add on a focus on ESG and sustainability, that has really elevated the dialogues that we have with management teams and boards.
I think that's an awesome way to end our session. I mean, really, on a positive note, this was really a great conversation. I want to thank our speakers for spending time with us and teaching all of us so much. I also want to let you know that we have other events coming up. So please join us for our next event on October 21st. It is a fireside chat with alumnus Bob O'Shea. He's the founding partner and chairman of Silver Point Capital, and one of our adjunct professors, Michael Gatto. And they're going to talk, and he's also a partner at Silver Point Capital, and they're going to talk about their careers and the credit markets. So we hope to see you all on October 21st. Thanks so much. Have a great night.